It is shocking how many business owners fail to read their financial statements or even contemplate why they should read their financial statements, and even further, what goes on a financial statement. Today, I'm going to be talking about how I read financial statements and use those documents to manage your business. If your business is growing, if you're making decisions on what to spend, what to buy, where to go, how to invest, you should be doing that from the perspective of your financial statements. They should be telling you a story that helps you manage your business in the most effective way possible. Because remember, we're looking for profit, and the only way you can determine what is leaking from your business is by reading your financial statements. So I'm going to give you my viewpoint on how you should be reading your financial statements. Let's talk about what the financial statements are. First and foremost, one of the statements you probably know, this is the most common, is the profit and loss. Some people call it an income statement. It is the statement that tells you whether or not you're making money. And so most people have an understanding that a profit and loss is a statement they will have seen or will have heard about. But that statement does very little good by itself. It is supposed to work in conjunction with the other financial statement called the balance sheet. Now, the balance sheet has the purpose of determining what your business is worth. So it's like a personal financial statement that shows your net worth for your business. All of the decisions that you make that drive your profit and loss statement should end up on your balance sheet, making your company more valuable, a target for acquisition, able to scale, knowing how you can reinvest. It should drive your balance sheet in terms of your financial decisions. Here's how I would review a financial statement from the profit and loss perspective. I start at the bottom and work my way to the top. And there's a reason for that. I'm going to share it with you in just a moment. The different components, as I go through this, you're going to need to understand what the components are so that you understand what I'm saying. The top line is revenue. You can equate this to your sales. When you make a sale, it goes into this category of revenue. The next section is the cost of goods sold, COGS, you will hear in the accounting world. The cost of goods sold is the cost associated with making a sale. So it is the raw material cost, it is the assembly cost, it's direct labor costs if you're a construction company and you're charging your labor based on the product. Cost of goods sold is the cost of making a dollar. Below that is gross profit. So what happens is you take revenue minus your cost of goods sold equals your gross profit. You will hear this as gross margin. It's the amount of money that your business is making after it pays the cost of producing that revenue. Below that is your overhead. This is SG&A. That stands for Selling, General, and Administrative. This is the cost of doing business regardless of whether or not you make a sale. So these are things like cell phone payments, insurance, rent, different liabilities that you may have, healthcare insurance, payroll for the officers, all of the expenses associated with running your business. If you don't sell anything, you're still going to have those costs. So that's called overhead, or SG&A is another term for that. And then at the bottom is your net income or loss. So let's talk about how I review a financial statement so that you can see where your eyes should go as it relates to the P&L. I start at the bottom. I look at, do I have a profit or a loss in this business? Is it making money or is it losing money? Right away, I'm looking for the positive or the negative as I review my financial statement. And then I work. If it's positive or negative, it matters, but it doesn't matter in terms of reviewing your statement. Then I go from the net income all the way to the revenue, because I want to know what is the percentage of my net income or loss relative to the amount of sales that I'm making. After I look at the revenue, after net income, then I'm looking at the cost of making that revenue. I should be targeting percentages in my mind. Most often, your gross profit should be somewhere between 40 and 50% of your sales, which means that your cost of goods can be between 50 and 60% of your overall sales. That is a healthy margin that allows you to understand I have a high likelihood of making profit. Then I work down to my overhead, things like insurance, things like rent, things like officer's salary, all of the things that it takes to run my business. And here's what I'm doing. As I'm reviewing this, I'm looking for my revenue. Is it where I expected it to be? What are my costs associated with making that revenue? Are they where they should be? Is my gross profit healthy? And then what are the expenses that stick out to me that tell me I need to ask some more questions? So here's, when you're reviewing a financial statement, the big thing that you need to understand is that it should cause you to ask some questions. If you have sales and your overhead, your cost of goods sold are too high, I should be asking myself, why is that? So if I have sales of $1 million, but my cost to make that $1 million is $800,000, that's 80% of my revenue. I should be asking myself some questions. Why are my costs so high? What are my vendors doing to me? Have costs been rising? Things been going up? What has been happening related to my cost of goods to produce that revenue? And then I look down. I go to my overhead. Is rent going up? Are my officer salary too much? Are my employee wages too much for my business? Am I right-sized? Is rent high? Is insurance high? I look for the big numbers in this section of the P&L. I should be keeping this section of my P&L somewhere around 20% so that I can drop somewhere between 20 and 30% to the bottom line. A healthy profit for most businesses is somewhere in that 20 to 30% range. So if my numbers don't match my expectations, I'm asking myself a lot of questions. Why is that? What is happening? What's going on? Maybe I need to charge more. I have a business owner that I'm working with right now who's leaking money out of their both gross profit and their net income, and they're not charging enough. Their business is really good. They're very popular. They're very good at what they do, but they're priced too low. They can't produce the work at the level that they're selling it for, and therefore their overhead doesn't get covered and they have to put money in. So they have a loss at the end of each month and at the end of each year. So 20 to 30%. These are numbers that you should be targeting as you're doing your financial analysis on your own financials for your business. Now, let's jump over to the other statement. The P&L, profit and loss, works in conjunction with the balance sheet. There are various components of a balance sheet. I'm going to start at the top and work to the bottom. There's a category called assets. These are things that you own that make you money. And they are broken down into a couple of categories. There's current assets, things like cash, things like accounts receivable, things like inventory. The definition of a current asset is that I can turn it into cash in less than 13 months. Another category here is fixed assets. Fixed assets are things like your trucks, things like your equipment, buildings. They go on a different balance sheet, and I'll talk about that in a different video, but things that are turning into cash in greater than 13 months. That is the definition of the two categories. So you have current assets and fixed assets. Below the line, you have liabilities and equity. Now, this is called a balance sheet, not because it gives you the balances of the things in your business, but because the sheet must balance. There is an equation for a balance sheet that assets equals liabilities plus equity. These two categories should equal the category up top. And if this is equal, if there's an equal here, this is called balanced. Okay? So we have assets, current assets, and fixed assets. In the liabilities category, we have current liabilities. These are things that are getting paid in, guess what, less than 13 months. Things like accounts payable, payroll payable, things like some car payments, some of those like credit cards, lines of credit, all of those are current liabilities. Then we have what's called long-term liabilities. This is in greater than 13 months. Equipment loans that you might have. Different obligations that you might commit to that are longer than 13 months would go in long-term liabilities. And then you have equity. Equity is broken down into a couple of different categories. There's initial capital. This is the amount of money that you put in to start your company. This number really should never change. Then there's owner contributions, owner's withdrawals, retained earnings. I'll explain these in just a moment. And net income. Okay, let's break these down. This is a lot of information in this category. Initial capital, this is what you put into the business initially to start. Owner's contribution, this is money you've had to put in subsequent to the initial capital that you put in that is having to fund your business. So if you had to put in money to cover payroll or whatever, goes into owner's contribution. Your withdrawals, when you take money out of the business, comes out of owner's withdrawals. Retained earnings is year-over-year profit or loss that have been retained in the company, and net income comes from the most recent period's net income. I told you a moment ago, these two statements work together, and this is what ties them together. Net income or loss goes right here on the balance sheet to help this statement balance. Retained earnings. Now, when I'm reviewing a balance sheet, the first place that my eyes go are right here to retained earnings. That is the very place I pull out a balance sheet, I go right to retained earnings. And the reason is I can determine whether a business has been profitable or has lost money year over year by looking at the retained earnings. If this number is positive, that business has either made a healthy profit in the current term or has retained profit over many years. Tells me about the health of the business. It gives me an indication of the operations without ever having to look at a profit and loss statement. I can go right here to retained earnings and determine whether I have a company that's been making money or losing money. Then I go to net income. Now, when I'm reviewing financial statements, I look at the balance sheet before I look at the profit and loss. So I go right here to net income to determine what is my most recent period. If I'm looking at year-end statements, it'll tell me what the most previous year has been without having to analyze all of this. Remember, this asks questions and this gives me the worth of the business. So I'm driving questions here and I'm hopefully answering some questions here. But net income gives me the most recent period. So I can understand what's happening over here by looking at a balance sheet and understanding here. Owner's withdrawal and owner contributions tells me whether an owner has had to put in money or is taking money out of a company so I can understand what's going on in terms of the mindset of management. I don't really look at initial capital because, again, that number doesn't change. From there, I go from equity all the way up to the asset category, and I look at what I'm dealing with. What am I dealing with cash? In business, cash is king. Cash controls everything. In fact, this statement shows us how cash moves through the system. This tells us where cash lands. That's supposed to be an E. Where cash lands. So I go up to the top and I look at the cash situation. Then I look at accounts receivable. I want to know who owes us money on a short-term period of time. And I look at what my fixed assets are. How much equipment do I have to do the business that I'm doing? Now, obviously, if you're a consulting practice, you won't have a lot of equipment. You're going to have computers and you're going to have some technology, but you won't have a lot of equipment. If you're a manufacturing company, you're going to have equipment. You're going to have like the line that the product is produced on, If you're a large construction company, you might have trucks that go out to the field. And so depending on what kind of business I'm looking at, I look at the fixed assets to know what I'm dealing with that can produce revenue. Then I look at who we owe. What are our accounts payable? And I do a quick calculation here of cash plus AR versus my accounts payable. And I'm trying to determine, do I have enough cash or easily convertible cash to cover my current liability situation? So that quick ratio I'm doing in my mind so that I can determine if I have a business that's viable and sustainable on a short-term basis. Then I look at the long-term liabilities and I determine, what do I owe on a long-term, and am I upside down? Am I good? What's happening there? So these are the components of the different statements you should be looking at on a monthly basis, if not more frequently, to determine the health of the business. This is how I make decisions using the two statements together. If I'm going to make a purchase, let's say I want to buy a $10,000 truck. Can't probably buy a $10,000 truck these days, but let's say I'm going to buy a $10,000 truck. That money for that $10,000 has to either come out of cash or has to go on a loan. One place or the other. So I'm either going to reduce cash and move it to a fixed asset, or I'm going to add a liability and I'm going to purchase that truck. That decision is one level of decision. How am I going to fund this? If I have enough cash, maybe it makes sense to pay cash and utilize that truck in the business. But more important than that, what I do, if I'm going to make a $10,000 decision on my business, that $10,000 needs to represent a 10x revenue generator for me. So if I'm going to make a $10,000 purchase, that needs to result in $100,000 of upside revenue in order to make that decision make sense. Because I'm not going to have any additional cost of goods sold related to purchasing that truck, but I am going to have interest expense if I put it on a loan here. And that additional $100,000, if I keep everything the same, and I use my current percentages, let's say it's 50% here, 30% here, and 20% here. So 30% or 50% cost of goods sold, 30% is my overhead, and 20% is my net income. That additional $100,000 represents a $20,000 gain in my net income if my operations stay the same. So that $10,000 driving an additional $100,000 in revenue results in a $20,000 tick upward in my net income, which drives my equity up by $20,000. So the way that these two statements work together is, if I'm going to make a decision to purchase a piece of equipment or to invest in something financially in my business, I didn't need to determine how I'm going to finance it and what I'm going to do. That's on the balance sheet. And then that decision needs to result in a 10x revenue jump that, if I'm holding my numbers correctly, should represent a 20% net income jump, which drives my equity up by an additional $20,000. The whole purpose of your business, I've said this over and over, profit is a love language of a business, but a business's worth is what we can cash out on for our legacy. If you're going to have an equity event, it's going to be in one of two places. It's going to be a multiple of net income, or it's going to be a multiple of your equity. This is your value. Driving the equity up allows you to sell the business for a multiple of your equity, or you're going to sell it for a multiple of what is called EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Because interest expense is here, we're going to add that to the net income. Depreciation expense goes here, we're going to add that to the net income. That EBITDA figure is going to drive the purchase price if somebody wants to acquire your business. Or the value that you have, 20 grand going over here, lets your value of your net worth go up, and someone will offer you a multiple of your EBITDA. When you're levering your company, you're going to your bank to get a new loan. The bank is going to look at a couple of different things. They're going to look at you personally, of course, but they're going to look at the history of your business to make net income. They're going to look at the value that you have. Are you negative net equity or positive equity? Because this is what allows them to get paid if this goes away. They can transfer equity to pay off a loan. So a bank is going to be looking at your net income. They're going to be looking at your trend. They're going to be looking at your historical performance as it relates to driving net income. And they're going to be looking at your management level decisions as you make decisions financially for your company. Profit and loss and balance sheet are two of the most powerful statements that you can be reviewing and should be reviewing in your business. If you are making financial decisions without reviewing your financial statements, you're making a big error and you're sacrificing massive profitability. If you're not using these statements, you don't know where profit is leaking, you don't know if you're overpaying, and you don't know where your value is in your business. These two statements working together are a powerful tool for every business owner. In order to complete them, you need a great bookkeeper, you need to have your accounting in line, and you need to make sure that you're keeping records of all of the financial transactions that are taking place in your business. But I want to encourage you today, make sure you're reviewing your profit and loss and your balance sheet on a monthly basis to make effective decisions to grow your company.